Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Monday, March 21st, 2022. What we're going to do is take a look at the equity markets and one of my, at least one of my sentiment indicators, put-to-call ratio. We'll do that real quick. Update on that, and one I've covered already, but do want to point something out there. Want to look at Treasury bonds and more specifically the yield curve and talk about that, what that may be telling us, what's going on, or what's going to happen. More importantly, going forward, we can all look what's going on that's happening day to day. The big thing is to try to figure out where we go from here. So we'll look at that. Quick update on the lumber trade idea, and I want to, with that, I'll look at building permits with you real quick. We'll take a look at that chart. Quick update on crude oil. And finally, just some brief updates on the those ag input trade ideas that I shared the other day, MBII, RKDA. We'll go over those, maybe a couple others. All right, starting out here, this is what I got out to you this morning, so I won't spend a lot of time on it. 60-minute chart. We had, as I mentioned on Friday before the close, an objective shorting up at the 352 resistance level, pretty good resistance. And so far, that stopped the rally cold. Nothing big so far. It's a pullback for sure from that level, off the 352 level. It's about into today's lows so far. That is about a 2% drop. We also took out the trend line there, breakdown and back test of the purple trend line right there. And again, I don't see there. We could stop anywhere in here. I could find some minor resistance levels, around where we are, but I think we'll come back down to at least that 341.50. That'd be my minimum target. And whether or not there's going to be much more downside to that, one thing that what I don't see, and it would be nice, but you don't have to have, would be to get a divergent high on the 60-minute chart of SPY and QQQ. So let me just, I'll zoom in here on the indicators and show you that what we do have an extreme overbought condition, as shown on the RSI, and that's not unusual after breakout. Remember, if this is the beginning of a new uptrend with much more upside to come, and it could be, then it's not unusual to see oversold or overbought readings, a little pullback, and then you go on, you power through, and you become more overbought, or you hit it again. And if you hit it again, but a little lower level, that's what I was talking about, negative divergence. Right now, you have a peak high right here in the RSI, but you don't have a lower high. We had, in many cases here, we had divergence. Some of these, that one's marked right there. That was the last divergent high on the 60-minute chart, and it coincided also with a false breakout or a failed attempt to break up above the trend line there. So that is one scenario, and as I said Friday, I took some shorts going into the close on Friday. I won't go aggressive right now. I don't think it's time to be aggressively short or really aggressively long for that matter, because there's just not enough evidence to say that this is nothing more than a bear market rally. Once we start taking out the 200-day moving averages and levels above that, then that case will build. But the case for maybe for new highs, but as of now, can't be made. And again, this is something I'll be looking for. If we get another thrust up, my next resistance is about 351.80, give or take. There's big resistance around 369.50 or so, or pretty decent, I should say. Not very big, but decent. And maybe I'll throw up some Fibonacci clusters as well and look at that. So that's it. Gosh, I'd almost give it coin toss odds, but like I said, if you took the short and you got anything close to that 2% pullback, and you're trading futures or anything, it's a good trade, a quick trade. You book 1-2% in a day or two. Average that out. Even if you only did that once a week, 2% times 4, that's 8% a month. That's going to give you a good year. But it's not always that easy. But anyway, so like I said, you can a lot of ways to trade. I can't tell you. There's a myriad, different numbers of possibilities. If you shorted the 352 or the breakdown, you can set a stop at your entry. You could set it a little bit above. You could trail down a stop. And if you're bullish and long, like I said, your most objective levels are either pullback to support, which in this case, first good one I see is 351.50, the same as that first, 341.50, same as that initial downside target. Or you take a break above resistance. If we can power through 352 now, that's a breakout. You can see that since last week, boom, 1, 2, 3, 4 of these 60-minute, 4 of those 5 60-minute candles there all failed right at the 352 resistance level. So pop above it, especially a solid 60-minute close, will be a breakout. Now, a lot can happen there. You can go up, maybe make a back test to the purple trend line again, something like that. But as of now, like I said, that's what I'm looking at. It put the markets on a sell signal. The fact that we had a rejection there, that was more of an objective short entry. The sell signal then came on the break and the back test of the trend line, and so forth and so on. So that's it. I wanted to point out that we do not have divergence on the 60-minute charts. It is not at all a requirement to end a counter trend bounce, but I would just be interested in, and maybe if we get it, I'll add shorts back if I cover this one. I'm still holding those shorts for now, but would certainly, whether I cover them or not, may look if we get that divergent high, especially if it's at support, and especially if we have a sell signal. Maybe we set up a new trend line, maybe a rising wedge or any other type of pattern, and get a breakdown. So that's it. Let's look at the longer term charts now. Daily chart. Turn off all the price. Well, no, we'll leave this on because I gave you this daily on Friday. 351 on the daily. I had the line, the blue line that we what I highlighted as an objective shorting up at 351.68. We're right there, and that's so far a pretty decent rejection. Here's the thing, guys. I've said it. I said it before it even broke out. And even went long down here. Said this is bar none the most bullish setup, most bullish technical setup I've seen in a long time. And so far that bullish setup is good for about a 15% rally, or no, I'm sorry, it's only 10. Not 15, about a 10.5% rally in the Nasdaq 100 off the lows. However, if we are in a bear market, and there's we certainly don't have a confirmed bear market, at least not by my definition, and we haven't seen the S&P fall 20%, even though the Nasdaq 100 fell 22. But going off that assumption, then that's what a bear market rally will look like. It'll be convincing. It needs to be convincing, because if it is a bear market rally in the bigger picture of things, what we had really off the highs in November here was the first leg down, and you could have a counter trend rally, and then the next leg down is most likely going to be a bigger wave of selling, more powerful leg down, and that should take us to, I think at this point in time, because we've had enough consolidation, we came halfway down between my first and second targets, that I think if we break the recent lows, we'll probably have a very little, minor if any, reaction off T2 and maybe continue down. But I don't want to get ahead of myself right now. That very near-term trend is up. Again, in addition to that big bullish falling wedge that broke out, we had a nice bearish engulfing candlestick. I'm sorry, bullish engulfing. The green candle engulfed these previous, actually engulfed 1, 2, 3, 4. Engulfed the 4 previous weekly candles. All these guys right there by that one there. So and if you're trading that, and you can recognize it, what you want to see is some follow through. You certainly help to see another green candle this week, maybe run up at the 200s. Obviously if we start to fail that, and really when you go under about the midway point, especially 3/4, that's it. At that point, especially the following week, there's no follow through to it. And keep in mind as well that bullish and bearish engulfing candles, the way I like to use them, I find them most reliable is they are reversal candlesticks. They will indicate a trend reversal, and again, you do need the confirmation via additional red, or I'm sorry, in a buy signal, bullish engulfing, additional green candle, at least one, all the better if you can get a follow through. But they are best used at the end of a prolonged uptrend when you're looking for a bearish engulfing, which you got here, and I pointed that out back right here, the week ending November 26th. I pointed that out in both SPY and QQQ. Bearish engulfing candlestick there, and that marked the end of a prolonged uptrend, which is so far marked the top, and we are still in, despite the the rally that we've had. We're still in a downtrend for now when you look at it from that perspective, and we're still above the key 200-day and 40-week moving averages that are above. So again, work to be done. Finally, let's look at SPY real quick. SPY, this is a weekly chart as well. There's your 40-week moving averages, which again are the 200, same as your 200 days on the daily chart. And at this point in time, all that is a breakdown and back test. We had a stick save there. We never broke them on the weekly. That we closed right back on or a hair above the 200 exponential or the 40-week exponential. The red line held it again. So 1, 2, 3, 4 successful tests of the 200-day exponential slash 40-week exponential moving average there. And this is the breakdown candle. We had a solid close below the following week, close below it the next week after that, close below it the following week again. And right now what we've done is we've come back and we're back testing. We took last week we did recover the 40-week exponential, but we still haven't recovered the 40-week simple moving average. We're still below that, and that's going to be resistance as well. And you can see that sometimes it's one of them that does a trick, and sometimes it's the other. So I like to see both taken out to make a bearish case, and then I like to see them both recovered as they were right here after COVID, recovered and successfully back tested there, successfully tested from above. Again, once you're above them, they then become support, and it's buying opportunities to get pullbacks to those. And once you're below them, it becomes resistance as it was here. And you go back to the last bear market, and you had some really beautiful shorting ops that when those levels were back tested once they were taken out. There's the bear market from '07 to '09. You clearly took them out right there after flirting with them for a couple months and multiple tests along the way. Took them out clearly right here. Came in and back tested for a few weeks, and that was it. And so if you didn't get out of your longs at that point, that was the last chance. The train had left the station. You had one last chance to exit your longs and or get short before the big drop came. So we'll see. It's hard to say right now where we're at because sometimes you go through them and like we did back in 2018, you took them out, had a leg down, but then boom, popped up and regained them, and the bull trend continued. So I'll continue to update this regularly. Let's just look very long term now. I'm going to park these indicators first. We'll look at price, and then I'll pull all these indicators back down. Pin each one of them. That didn't work. Pin. Should pin. Oh, it wants me to move the whole pane. Let me pin this one. I think that one will pin. There we go. Should pin. There it is. Okay, guys. All right, so this one I've covered many times in the past. This is SPY, the S&P 500 tracking ETF, monthly chart. Big picture here. You've got your divergent highs and your bear markets that follow 20% drop. Divergent high, 51% bear market there. Everything I've covered many times in the past. That was 2000 to 2002 bear market, 51 roughly percent drop. 2007 to 2009, roughly 57% drop. Even the corrections along the way, 22%, 15, 20, 36, and 15 I have a question mark there because I still believe we will hit whether it's going to happen anytime soon or whether it's going to be in a few months from now, later this year. I still think we'll come at minimum come back and test the bull market. This is the bull market uptrend line. When this primary uptrend line off the '09 goes, then in my opinion we have broken a secular or a major cyclical bull market uptrend line at least, and then that can open the door to a much bigger drop. But as of now, we're still flirting around and back above my first target there. And what we did is we came down and tested that big, I love that 20-month exponential moving average. Defines bull and bear markets, and so far it's successful test. So I have 15% with a question mark because that's rounded off, rounded to the nearest percentage point. That's how much we've dropped from high to low in the S&P 500. And now, so we are below trend. So to me, it still looks like a breakdown with more to come, especially considering everything else on the chart. We have my PPO indicator right here. It's simple but effective. When the PPO crosses over, it's in bearish territory, puts the histogram red. And again, I've showed you this. This is even in the bull market, not a bear market. Bear markets are much bigger, but even in the bull market, these are all the corrections associated with the red drops here, 36, 20, with the crossovers, 15, 22. And then, if this is the beginning of a bear market, then you're looking at much bigger drops, 57% back there, 51 back there. So that's what your bear market numbers are looking at, averaging around 50% or so. And corrections I guess what I would consider the modern definition of a correction really should be that 20% drop off a high. It's the old 10% rule, and 20% defining a bear market, I think, is antiquated in this day and age of increased volatility. Okay, now a quick update on one of my sentiment indicators, the CPCE. That is the equity put to call ratio, one I've covered many times. So on the very bottom of the screen here, you're looking at the S&P 500. This is the market peak in October of 2007, followed by that 57% drop right there. And what I'm going to point out here is that all the big corrections, every significant correction, if you just look here at these circles that I have down below, including the end of that bear market in March of '09, we had a big roughly 21% drop correction back there, about a 16, well, from high to low about 16% in the S&P, but remember, small caps, I think even the NASDAQ 100 had 20% or more drops, and it was almost 2 years of a sideways market. And here's where it ended. Fourth quarter 2018, big drop, over 20% in many indexes, 36% in the S&P 500 when COVID hit. And look where each and every one of those ended. The bear market of '07, or ended in '09, March of '09, ended with the put to call ratio, the equity only put to call ratio right here in that green zone. We had this drop here. Had a couple of spikes in there. This is the one that finally ended it right there, that 21% drop. When this correction here, and again, I'm hitting all the big ones, I'm not skipping over any, 16%, again, almost two, there were several drops of that magnitude, and then boom, it ended with a spike into that zone. Each other spike ended with followed by a rally. The big Q4 2018 drop, there's your spike, and it just shows fear that market participants were afraid and bought a lot of put protection, hedged up, and that puts a floor in the market. And when you're with spiking or surge in put buying against call buying, you're also going to get a surge in short selling, and then that actually puts a floor in a stock or the market. When there's too many shorts, they're forced to cover, and it shows sentiment at an extreme. When COVID hit, you hit the bottom of the green zone right there, and it took that spike before everything was said and done. What happened this time around? See these question marks? Not even close. I mean, we didn't even. This is where we bottom right here, coming up, and this indicator was right here, about on the line. And this is the other thing I use this for. I've covered this many times. I have that red line. It's not randomly placed. I studied the chart. I put a moving average, 100-day moving average, to smooth out the put to call ratio, which is in these spikes here in black. It looks like an EKG. By smoothing it out with a moving average, it gives you more feel, and it takes out those those quirky spikes that sometimes don't mean much. And so when the moving average falls to this level, as I've covered it before this top, long before this top was in, I say there's a lag time. You have the initial tag, and then usually it takes about a year or so of that persistent bullishness when the put to call ratio is very low before the actual top is in. And so it happened before that last bear market, '07 to '09. It happened back here. You had the tag, then the 21+% drop, then you had the tag there, and that sideways market for 18 months or so, and plus several corrections in there. And then you had this tag most recently, and again, it took a while, took about a year, and finally we've started to go down. The big question, is it over? Based on this extreme sentiment, how extreme the bullishness got. Before, we just used to tag that level. This time we hit it and we crossed below. It's a new era of bullishness. I think after COVID, when the Fed was able to save the day, I think now that the majority of market participants view the stock market or the Fed as omnipotent. That meaning they can just stop anything. And again, they're faced now with different challenges they didn't have. They did have the ability to pretty much go carte blanche and write whatever checks they wanted, print as much cash as they wanted, take rates as low as they wanted. And now inflation's running away. So this, to me, has longer term implications, and that's why I think it's a matter of when, not if, we're going to go down and hit my additional targets. And again, this is just say what you want, but this is one of the best measures, in my opinion, of market sentiment because it shows where the actual bets are being placed. And again, something's missing here. Either they're feeding me false information, or I'll take it on face value. I don't think that's the case. It just shows that so far, despite everything that's gone on, there's just not enough fear in this market to indicate a lasting bottom. And now let's talk bonds, boring old bonds. But a lot of experienced investors, traders, professionals, they'll follow the bond market closely, even to get glean clues where the stock market's going. And this is TYX. This is a yield on the 30-year Treasury bond. I've talked about it many times. Up until into the very early 80s, we were in a secular trend, a secular bull market in rates. Meaning interest rates were going higher, higher, higher. We had runaway inflation at comparable levels that we have today. However, this time around, the rate of increase is much, much faster than back then. That was a slower developing thing. We got to the same, we're at those levels we were 40 something years ago. However, it's happening much faster now. Anywho, so from that point it peaked, early 80s, and we have been in a very clear, well-defined, these yellow lines that I'm overlapping here. I have a couple different lines, but these yellow lines that I just overlapped show that we have been in a secular bear market. That secular is the larger trend. Within there, these are little micro or cyclical bull and bear markets and rates. And remember, bond prices move inversely to rates. And then what happened is you had, in recent years, starting with the financial crisis back in '08, you had these rounds of massive intervention by the Federal Reserve, stimulating the market, doing bond purchases, quantitative easing, and you get those spikes down. So they took rates artificially low, well below where they should have been. This is a natural channel, natural market forces taking rates down long term. And now after that overshoot, I talk about wedge overshoots sometimes, and you have let's say a bearish rising wedge, and it looks like it's going to break down, you're moving up, and then all of a sudden you have a spike up, and then I'll look for a reversal down and through, and that's usually a powerful move. And that's what happened here. We had a channel overshoot of the price channel, the yellow lines, and we're back above it now, and we're climbing. So longer term, I think, as I've said, best case scenarios, we stay low, we stay in this channel, but if we're at the end of this secular bear market in rates, which if you've ever had in that 30-year period a strong case to say that we are, it is now with inflation growing, surging at rates we haven't seen, and even the outlook now, with cutting off Russian oil and natural gas. We know those things. That's the best case scenario. Maybe those prices stabilize, level out, but we're not looking at cheap oil anytime soon. Is very unlikely. So. That's going to keep, bottom line, it makes the Fed and the ECB, all central banks, makes their job a lot harder to keep the spigot of easy money flowing. And I'm going to get to some other things in a second. They're going to kind of mesh with this. But either way, that's where we're at. And again, I'm showing you just long-term macro picture, and we'll watch this. And now that we've entered the channel, usually when you fall out of a channel and recover it, your chances are you're going to go back to the top of the channel. There's usually some reactions along the midpoint of the channel, but now we're popping above that, so we're probably looking at, forget the minor zigzags. I'll always show you the quick trade opportunities, little, like I said, tactical trades in bonds, but longer term, the outlook looks like we're looking at longer rates, which means lower bond prices. And now that kind of all ties into this. All right, so I showed you, let me do this again. Let me go back before I get to the yield curve. Let me just show you. So remember, TLT is the price of the 30-year bond, and that has been going up for years. It wasn't around, it's an ETF, so I can't show you the bond prices. If they were on here, it would just look like this. We'd be going back, and this is the upward trend. Remember, bond prices and yields are inverse, and so we've been in a secular bull market for interest rates, but now we know that bond rates are going up, interest rates are going up, so bond prices are falling, right? But what's happening, and let me just go back a little bit shorter term here now on the daily chart, there's TLT, 30-year bond, which again, that's when we hit the floor. Nowhere lower to go, and the 30-year bond has been falling, and the outlook for, I think, for years, if not decades to come, is bearish. Bonds, I think, will be one of the worst returning vehicles, and we know that in an inflationary environment. But what it's gonna do is there's a cross current right now. I've talked about it. Inflation, by that aspect, if people believe inflation is going to be a lot higher, they'll demand a higher rate on their bonds. Yet, this is an ugly situation because you're hearing more and more about the risks of stagflation, which is when you have a inflationary environment, prices are going higher, but yet economic growth, i.e. the economy, is either in a recession or very slow stagnant growth, not growing, and that also can impact bonds. People don't want to, bonds are being priced out for future growth expectations, which kind of go in line with inflation expectations. So there'll be some cross currents there for sure. We'll trade the charts, but here's what I want to show you: is you can see the TLT is really falling hard, but not as hard as the short-term bonds because their rates are going up proportionally faster. This is SHY, the 1 to 3 year bond fund. Remember, the Fed is now raising rates. They've already started, first of many to come. That's the expectation, raising the short-term rates. And so what you have is, and we'll go back to that yield curve now, that is when short-term interest rates go up and long-term rates fall, that gives you the yield curve starts to flatten. So in a normal yield curve, you're getting a lot more on long-term bonds, on the 30-year bond, than you are on the 1 year or 2 year. This shows you the the 10 to 2 year spread right here. So the spread between the 10-year Treasury bond and the 2 year bond, it's right there. And you can see, as it says here, I've covered this many times, an inverted yield curve has predicted the past 7 recessions. This line is where it inverts, meaning that the yield on the 10-year drops below the 2 year. So we know we're going to continue unless something different happens with inflation and everything else. We know we're going to continue to see the short term of the yield curve go up. That's pretty much almost a guarantee at this point. In my opinion, and that of a lot of others, the Fed is way too lax and behind the curve, and it's taken us too slow. I don't know what they're waiting for. I think they're just praying and hoping there's some, all of a sudden this inflation surge just abates out of nowhere. They've been wrong all along, and so again, the charts tell me that it's not going to go away anytime soon. We'll see. So let's just assume we're going to continue to see the 2 year go up, and then the 10-year yield. It doesn't have to go down. It just has to go down less. And it can go up. The 10-year, I'm sorry, it just has to go up less. That's what I was trying to say. So we can still see a rising 10-year and a rising 30-year, but this end of the yield curve, if it goes up more, will invert. And again, this isn't my thing. Everyone, if you've traded and studied the markets for a long time, this is one of the most accurate predictors. These shaded gray areas right here, these boxes, show you all the recessions. And again, it has a 0 failure rate. It even caught the last one. The last one was very brief. The Fed made sure of that, and DC, of course. It was a combination of fiscal and monetary stimulus, and it made that one of the shortest recessions on records. But it was one, and it was accurate. You got the little inversion there, and now look where we're headed. So for the rates not to invert, here's the yield curve. You can see right up here, this is the flattening of the yield curve. Long-term rates, short-term rates have been boosting up from where they were a year ago and are going to continue to grow up. And if the long-term rates either stay where they are, especially if they drop, you're going to invert. And this is how it looks on the 10-year to 1 year spread. And again, they're headed down and most likely poised to cross. But we'll see. Something we monitor. There's very few instances where you've seen the cycle turn and start to head lower. In that case, you almost crossed. You didn't, but eventually you did, and you got the signal. You got it there. 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 That one was effective. So we'll see. We'd have to turn around now and not get anywhere close to there. avoid it. But again, I said I've called this, I refer to this as Ursa interruptus, meaning interrupted bear market. There was a bear market and a recession that was due, long overdue in the economy. Again, they're not, I don't wish ill on the economy. Recessions are a natural part of the business cycle, and they are necessary. It is unhealthy to prevent recessions the same way it is unhealthy for the Forest Service not to do those prescribed burns in areas where there's a lot of dry underbrush. And if they don't burn that down intentionally and they let it build up and build up more scrub brush and dead, leaf litter, when a big fire comes from lightning or campfire or however it comes, it's going to burn the whole forest down, 100-year trees and all. And that's the same thing in the economy. You need to wash out. You need to have recessions to wash out the weak companies. There's too much competition, and then those that survive emerge a lot stronger. Anywho, that's, you can see we're spaced out. This is, in the past the recessions were more frequent, and then we had strong growth coming out of it. A quick chart. I just want to show you this is the Case-Shiller U.S. home price index and building permits. I have building permits in blue. That's a gauge of, obviously, building permits. If things are hunky-dory and the economy's strong, you're going to see a lot of building permits. So obviously when COVID hit, it dropped off. But this line here shows you that's the mean right there, and or the trend line, the overall trend line there. And what happens is there's always going to be, or there always has been, almost always is, reversions to the mean. So you got ahead here, big surge in building permits in 2014, early 2015, but you came back. And when you come back, when you get that far away from the trend, you tend to overshoot and then come back there. So you stay on trend. There was a big dip. Everything was heading back up towards it right at the trend line, and then COVID hit. Boom. Then there was massive stimulation in the economy, and things went the other way. You back tested the trend line, overshot it, of course, from the overstimulating the economy, came back, tested it again, but another big surge. And again, this is just from massive overstimulation of the U.S. economy. But we will see, I believe, at some point, the trend line over time is going to change. No matter what, you're going to have a reversion to the mean. You're going to check the trend line, and because of such a big overshoot to the upside, it's probably going to be a pretty ugly overshoot to the downside. Because we got so far away from it. And this one we can see too, the home price index goes along with it. Home prices are higher. You're going to see more building permits and people, more and more homes being built. This is the Case-Shiller home price index on the U.S. here. What I wanted to show you is the Okay, here's where it is. I had to pause the video and find it. This is the price of lumber. We're going back 20 years. This is a weekly chart. And we have a short trade on lumber right now. I'll get to the updated 60-minute chart in a second. But here's a 20-year history. And unfortunately, I haven't found a way I haven't found a charting platform where I can overlay the two that I'm about to do together, this chart of lumber. But you can see, and I can tell you, you can eyeball it and see that it ebbs and flows, obviously, with the housing market. That's one of the biggest uses of lumber, of course, is building homes and commercial buildings and all that stuff. And you could see back in 2018 had a peak, a big drop there. There's a COVID hit, and it's surged since then. So, the fate of lumber, and commodities are in a bull market, no doubt about that, but lumber in particular is very sensitive to demand for housing. So we're going to look at this chart here, and that would be, this is the Case-Shiller home price index overlaid. We're going back. This one is I just showed you 20 years. This goes a little bit longer, but you can see the trends are the same. Again, I can't overlap them together in the video, but all these trends, and again, compare it, do it yourself. I have multiple windows, but I can't include them both in this video, any two of them. But it's mirroring each other almost perfectly. And then what we come down to is look shorter term, and you can see now it's too early to call a top. But we know this. I just saw a headline hit the other day. Was the title of the headline from the Journal was low something to the effect that the low is in on mortgage rates, and they showed what the long term, the monthly, or the average is were for the 30-year mortgage, and we're long. That's long since in the rearview mirror. It just hit 4% recently, and not too long ago we were able to refi or take a new mortgage out at 2.5 or lower in some cases, and so that we know that's going to certainly cool things down, and it could certainly also let out a lot of hot air. And to call the real estate market a bubble, I'd say undoubtedly in certain areas, Miami, certain metropolitan markets, even where I'm at here on the West Coast, Southwest coast of Florida, other places, as I'm sure you know, and then some places not as hot, but frothy everywhere. And the bottom line is, so this is going to affect that where lumber goes going forward. If we continue, as I expect, there's a pretty good lag in this report. We're going to see, I think, home price index continue to fall, and that's going to put pressure on lumber. Now, short term, we're going to trade lumber mainly off the 60-minute charts. Sometimes I'll certainly always look at the daily charts, and I'll give you a quick update on that trade. We've been lock limit down all day. Lumber futures are down 4.81%. Just to kind of recap this trade, we had a bearish rising wedge back here. There was our sell signal, broke down, started falling. Each of these little blue areas here that aren't really candlesticks are when we hit lock limit down, where that means they stop trading. You can only, it's not a trading halt. They could only, when it goes down so much, you can only purchase or sell it at a higher price than where it was locked at, the bid. You can't sell any lower. You can't short at that point any lower. You have to sell at a higher price. Likewise, lumber is a volatile sucker. These are all lock limit up. It was going lock limit up on those blue dots. And then what it did is it set up, this was our last trading op here, another bearish rising wedge with another breakdown giving us a confirmed sell signal. That was our short entry. And then what I point out, this, by the way, is a 6-month chart with 2-hour candles. Yeah, this previous reaction high was my first target at 1227.50. It was hit right here. We broke it. We back tested it. Went down, hit my second and then third target, bounced, and we had another back test of that first target, which is resistance. Remember, support once broken becomes resistance, 1227.50. And so far, another rejection off there to lock limit down right on the second target again, 125.85-ish, give or take. And so if we can go on down and take out the recent lows, as I suspect, we may come on all the way back down here to that max target at this point in time, 825 or so right there. Quick update on crude oil. Crude oil has been resilient. It managed to get through both that 104.10 on the May contracts. Remember, these just rolled up to the next resistance zone, about 106.40 to 107 right there, and actually took that out. So, but what we do have now that we didn't before is divergence on both the RSI right there and the PPO. So this is now the first time in a while, and what we also have since last week, we're starting to form a pretty decent uptrend line that's also taking the shape of a wedge if you add in those divergences. So hard to say where it stops, but I can tell you the next resistance is 111, and that would certainly be an objective shorting op there, or a place to exit any longs you're in if you're long right now. And then you have these two reaction highs here, one there and one there, and that's all the way up to 112.52. So that's a resistance zone that runs on CL on the May contracts from 111 to 112.50. And then you have a trend line here. So if we get there, that's an objective shorting area. Or if you break the trend line first, then that would also be. And then it works this way on the way down. That was a resistance zone. It's taken out. It's now support. We certainly consolidated around it. We had enough reactions to help validate it. 106.30 to about 107. Then about 104.10, and then the big one here is 101.90. That's where I think the next pullback will take us if and when we get that. Remember, this is very news event driven right now, crude oil, with everything going on over in Ukraine. And the last two quick updates on that MBII. This is one of the ag input stocks. Those are the sectors that contain fertilizers and similar type companies. Big divergent low price stock, as I mentioned, higher risk but high return. And it broke out, hit T1 the first day, hit our first target, had the typical reaction trade around there for a couple days, then powered through, as I mentioned last week. printed a solid close above the T1 zone, so that should open the door for a move up to the next target there, T2 at 133. Any pullback now to the first target zone could be an objective shorting up with a stop somewhat below it. And the other one that's I mentioned in the video was just about a week ago today. I think a week ago tomorrow, actually. 6 days ago was RKDA when I covered this sector in the trade ideas. It's another low price one, but I've traded for years. It just never seems to go away, even though it visits penny stockville. It's always around. And these are what I call like the third tier, lower, smaller, higher risk, but higher return potential in the ag input sector. And I mentioned this one that it had broken out and was testing. It's a very volatile stock. It moves a lot in a day, the daily range. So it's, as I mentioned back then, a week ago, it was testing and back testing this level. And I said we need to clearly get away from that trend line. Right now, the day's still not young, but not over yet. We're at 156 right now, and if you look real close, we're really testing these recent highs from those two candles. If it can power on through here and get a little bit more away from that trend line, that should do the trick. You know, it's taken a little bit better volume today so far. It's up about 10% right now. It was up quite a bit more. And that's still your next target, 189. And then this is where, you know, final near-term target now is still, what is that, about 238 to 245. That's a resistance zone. And I just want to say the rest of the sector so far is looking good. NTR, you know, they had a big run up. This has to do again with Ukraine and Russia. A lot of fertilizers come out of Russia. They're a big exporter of fertilizers. NTR. So it's benefiting a lot of these, especially some of these are Canadian companies, and I'm seeing some continued bullishness in the bigger names. Mosaic right here, you know, again had a big rip. Nothing goes up forever. Some profit taken, some consolidation, maybe a little flagging action, and they're moving. So again, the play that I'm looking at now, in addition to these, you could certainly take these. These are more stable, but a lot of these have already run. Is those you know, lower quality companies that may play a game of catch up. Which other ones are moving here today? I already covered this one could run too. CGA, Y10. That one is a low-priced little sucker that tends to run when it wants to run. Seed, looking good here at the pullback to the uptrend line. Next target, another tag of 1080, but we already hit it once, so we'll probably pop it and go to 1439 would be my next target. That one alone, if it hits that target, that's about a 63% run. And so forth and so on. Let's wrap it up here. It's a long video, but I wanted to get all those things out to you. And we'll watch. Still, like I said, I think it's time to not be too heavy in anything. There's nothing right now that I feel, you know, I have very high convictions on. So I'm wanting to see how this whole bounce plays out, especially in the broad markets. And like I said, I you know, in the beginning of the video, I don't think that we've seen the lows for 2022 is what I'm trying to say. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.